All right, we've got two after, and again, I want to be respectful of everybody's time, so I'm going to get started here. Thank you for those of you that attended. Happy good afternoon. I'm Matthew Pasquale. I'm one of the three partners here at the Voluntary Benefit Shop. I see some friendly faces and names on the line. So good to see you. Those of you that I know and those of you that I don't. Thanks for coming on today. So a little bit about the Voluntary Benefits Shop. For those of you that don't know, we are a dedicated life with long-term care specialist. All we do every day is deliver this type of benefit to organizations, and we partner with great brokers like yourself. So we have a very methodical and detailed employee engagement and education process. And because of that, we get results that are five times what the carriers will tell you is the industry norm out there these days. And today's topic. Here's my contact information. I also put it in the chat. You have the ability to unmute yourself, and if you could save questions, either throw them in the chat as we go, or you're able to unmute yourself at the end. I will leave some time to have a discussion for those of you that have any questions. But today's focus is talking about life with long-term care benefits that can be used as an employer-paid or executive carve-out strategy. So, obviously this can be a voluntary benefit. It's been the most popular voluntary benefit over the past 5 years. But I think all of us have probably seen a clamoring for more groups to look to find creative ways to give more enhanced benefits, either for the entire population or as an executive carve out. And this is a great place to start. Everyone needs long-term care. They know it's a necessity and an important part of financial wellness. And as you can see from the slides that we're about to go through, it's increasing in popularity. So again, this can be a voluntary benefit, 100% employee funded, but more and more organizations are looking for creative approaches to do some sort of funding for this type of plan. So I'm going to do a quick recap of where we are in the industry with this type of market, some benchmarking, and then we'll get into the specifics on the employer paid strategy. And for those of you expecting Mike Walker today, I'm sorry you're stuck with me for this month's presentation. So I know you've seen some of this before if you've attended other ones, but again, we'll do a quick recap and then we'll get into the meat of the employer paid strategy. So this has been this hybrid life with long-term care plans have been the most popular voluntary benefit over the last 6, 7 years now, and also the fastest growing executive level benefit. The factors why it's increasing in popularity is because the population's getting older. It's not just those in the older age demographic that are clamoring for this. It's younger folks too that have seen loved ones go through a situation where they were not prepared for a long-term care situation. They get wiped out financially. Long-term care costs have skyrocketed. There's legislation in some states that are considering passing legislation to follow what Washington State did. So that's creating a buzz. We don't use that as the reason to implement this type of plan, but it's a demonstration of what a need for long-term care coverage there is out there these days. And this is a big one that factors into our conversation today. There's a lack of standalone long-term care options, especially on the group side. So all of you probably have an account or two, maybe more, that had or have a group standalone long-term care plan that simply cannot be a move forward benefit where they can't add folks or they're getting rate increases. We're going to talk about a strategy specific to that. And the evolution of the plan has really made this more popular. These hybrid plans have brought stability to what was a very volatile industry. This is some, again, benchmarking on the popularity of this policy increasing on this type of plan. The increase in new premium has been 22% over the past year. The number of employees wishing that their employer offered this type of plan, you can see how this spreads across all generations. And the number of companies that are interested in offering this plan is also increasing. That's increased by 29%. And lastly, over half of employees would be interested in purchasing a plan if their employer offered this type of coverage. So people want it, they just don't know where to go. Groups don't always know where to go. A lot of people think that those standalone long-term care options, they either have a bad rep or they think that there is no option anymore. So these hybrid plans are the solution. And again, I know this is a savvy bunch on here, but what is long-term care? Obviously, it's nursing home and assisted living facility type of care, but it's not just end-of-life care. It could be someone who has a serious accident, serious stroke, and these benefits also cover things like adult daycare or being cared for in your own house, which in-home care has increased in popularity dramatically because of the costs, facilities being back. full and having like a wait list to get into. And obviously, the need for long-term care is easily demonstrated just by the percentage of us that will go through this at some point. 70% of Americans, if they make it to the age of 65, most people are making it to that age, will need long-term care at some point. So statistically, most people will be impacted and need long-term care. 20% will need it longer than 5 years, which can take its toll from a stress perspective, certainly from a financial perspective. So you can see the numbers here. Okay, these numbers in red are national average costs. In facility care, 80 grand, shared room in a nursing home, 115, private room in a nursing home, 130,000. If you don't have a plan in place to help mitigate this cost, this can wipe out someone's assets and hard-earned savings that people were waiting, or planning to use for retirement. They can be gone in the blink of an eye if people aren't prepared. So this is a form of financial wellness and asset protection. And really, it's giving your loved ones, the people that you love the most, options once a long-term care situation takes place. And the most common misconception that we have to overcome when we're talking to a client and at the employee level is that a lot of people have the misconception that health insurance and the Affordable Care Act are going to help them during long-term care. As important and great as those two things are, it doesn't help with long-term care. Now, Medicare is something that somebody can qualify for, but it's limited to 100 days. Okay, so most care situations are going a little over a year and a half, so 100 days isn't going to be the end-all be-all. And Medicaid can kick in if you qualify again, but that means that your assets have been depleted, and that might not be ideal for everybody. So that also can limit your choices. Okay, so from a geographical standpoint, it can limit your choices. It can also limit your choices from a quality of care standpoint. So having this type of plan, again, gives you the freedom of choice and the freedom of being able to choose the quality of your care. So what these hybrid plans will do, okay, regardless of the carrier we work with, or whether it's a whole life, a universal life, or a permanent term, is it's going to be a fixed rate life insurance plan at its heart. This is not replacing life insurance that an organization already offers, because what the intention of this plan is to cover, the blind spot that it is covering, is the long-term care. Now, because it's tied to life insurance, that makes it more nimble, and I'll go over the advantages of that. But essentially, fixed rate never goes up like a term policy where the rate goes up every 5 years. It often can build cash value, and it has a death benefit. So if somebody never goes into care, it still has a death benefit, so like a sudden heart attack, car accident, whatever it is. But then if someone does go into a care situation and somebody can no longer care for themselves, the plan is going to protect the family's assets, their freedom of choice with care options, but the cash from the life insurance becomes available so the person navigating the care situation can use it while they need it. Okay, so most life insurance, if you think about it, is locked up until someone passes away or is terminally ill. This plan does the opposite. Okay, it gives people cash that can be used without limitation. Right, these plans are more nimble than traditional standalone plans that were reimbursements. This is a cash benefit that can be used for anything. So you can use that money. Say someone's being cared for in their own home in the beginning. Loved ones are chipping in. Okay, that's not something that you could get a reimbursement for. There might not be a bill for that, but you could have that money to replace lost income, pay that person's mortgage, keep them in their house longer where they're more comfortable. Who wouldn't rather be cared for in their own home if that's something that they could afford to do? This plan will, the cash benefits will simply adjust with the needs of the care situation changing. So the plan is nimble. It can be used for any situation. The money can go directly to a facility, but it also can be used for those informal care situations as well. So these plans, again, have brought stability, fixed rates, to an industry or a market that was very volatile. Okay. Now let's get into the employer paid strategy. Now that we remember what the need for the long-term care protection is. So the reason why a lot of employers are looking to implement this as an employer paid strategy is it's going to help with recruitment and retention of employees. I hear every week, a broker partner of ours coming to us saying, we have a group that wants to find a creative way to enhance their benefits, not necessarily as an employer paid, benefit, but it can be, or an employee or an employee funded benefit. So what better way to round out a benefit package than offering something that, as of right now, only about a third of groups have in place a sort of long-term care protection. So it's going to help employees protect themselves, their assets, their hard-earned retirement, so they don't get wiped out in a financial, and be in financial disarray once that long-term care event takes place. Those costs are just continuing to grow. So having something to help mitigate that cost once they are in, most claims are going to happen in retirement where they're no longer working. That's very important to have something, in place before these care situations may happen. Now, this benefit again is not intended to replace any, current life insurance or even a standalone long-term care benefit a company may already have. There's no coordination of benefits with this type of program and, like a term life insurance plan or a whole life insurance policy or even a standalone long-term care policy. This is covering a different blind spot. It's a new strategy. Now, another thing that is impactful about this type of offering, it's a way that people can have protection beyond their working years. So again, most group term life insurance policies, those are only set to protect folks during their working years. Once someone enrolls in this type of plan, regardless of the funding mechanism, that rate never goes up and the benefits usually never reduce. Some plans have a reduced life insurance, but we only offer policies where the long-term care will not reduce regardless of whether someone is working or in retirement. And usually the plans will last, at least to age 100, okay, for the long-term care protection. So we design, the carriers that we work with, we only work with ones that are intended to help folks even in their post-working years. So this is a benefit that lasts. This is going to help build stronger engagement and trust. Okay, the plan's fully portable, again, at the same rate. Not only at the same rate when somebody ports the plan, there's no conversion required, no evidence of insurability. So I'm going to show you how we can help people get coverage without medical questions, which is, not something you can get on the individual market. That carries through, even into retirement as well. So that's a massive benefit. So here's a recap on a few statistics. But 70% of Americans, if they make it to age 65, will need long-term care. Fewer than 1 in 30 Americans actually own a long-term care insurance policy. It's a huge unfulfilled need. There's a huge room for growth within your book. And again, only about a third of employers are offering this. And lastly, this is something that executives are clamoring for. Okay, we see employees up and down the spectrum clamoring for it, but it's hard to get executives excited about any benefits. And I think that's because it speaks, it speaks their language. They're thinking about protecting assets. They're planning for the future. They might even have, a financial planner that's working with them, telling them that long-term care is something that's important for them to get. And maybe they don't qualify on an individual basis. So here again is a strategy where, an employer can offer a benefit without a single medical question. We hit on this briefly, but just to recap again, there are very limited standalone long-term care options these days, especially on a group basis. Okay. So there's still some great individual plans out there, but you're typically having to go through a physical, providing family medical history, and it's a tedious process. And obviously people with pre-existing conditions, they're kind of stuck. Okay. Now on the group side, again, there used to be a bunch of carriers that were in this, okay, and they all got out of it because they priced it wrong. They were hemorrhaging money. They didn't know that life expectancy was going to shoot up the way that it did, that costs were going to balloon out of control, and maybe most importantly, that medicine was going to get to the point where people could live a lot longer with chronic conditions. Okay, so a lot of those carriers simply had to get out. Okay, and we saw the last group standalone long-term carrier, Unum, get out of the market as far as allowing new policies to be added, in February. So this is, again, a need for probably some of your book where you could show them a path forward, because these hybrid plans are the only way to offer group long-term care protection without medical questions as an employer. So this is the solution. Now, these hybrid plans are appealing. And again, we've hit on some of these as we've gone through the slides, but just to recap again, someone's getting a benefit 100% of the time. Okay. Even if they never go into care, there's a death benefit. So even if someone has that sudden passing, never needs long-term care, the life insurance is still going to the beneficiary. Because it's tied to life insurance, we're able to offer it without medical questions. Huge. The plans are typically more affordable because it can't take all of the factors of, what an individual plan can use as factors of cost. So it's literally based upon the amount of insurance that one gets and whether or not they use tobacco. Doesn't factor in sex, health conditions, anything like that. And many of the plans also build cash value over time. Now, there's term policies that we use that are great. Those don't build cash value, but many of them do. And that can be an extra value, especially on an executive employer paid basis as well. That's something that's very appealing in those situations. The plans and indemnity products, again, fancy term for it. You get cash. It's not a reimbursement plan that you have to demonstrate cost. So it's literally cash that can be used for anything, paying the mortgage of the person that's not well, if they're in their own home receiving care. Maybe loved ones are providing the care, and informal care can be part of that solution. Maybe they're taking time off work, or they need to buy supplies, or you use the money to pay the facility, the nursing home, assisted living facility. We all have seen, someone in one of those homes, been in there, and so again, the fact that home health care can be an equal part of the equation with these types of policies is massive to me. And again, the plan's fully portable at the same rate, no conversion required, no additional underwriting. Just have to make sure that it's still being paid for, even if a payroll deduction has stopped because someone is no longer employed. All right. Quick recap on how these plans work. Again, it'll vary slightly by carrier, by site estate, but they all work basically the same. Again, the policy has that death benefit. So if someone passes, death benefit goes to the beneficiary. If someone's terminally ill, then it's going to advance a percentage of the plan to the policyholder. The remainder goes to the beneficiary upon passing. And then the long-term care is triggered by 2 of the 6 ADLs that you're all familiar with. And the policy will begin to give cash at whatever percentage the benefit gives. In this example, it's 4%. And most states have the ability for the policy to up to triple in value. So if someone passes suddenly, this is an example of a $100,000 life plan. 100,000 would go to the beneficiary. In the terminal illness, 75,000 would go to the policyholder, let them travel, gift it, whatever they'd like to do. And then the long-term care would pay the $4,000 in this example up to 25 months, giving them their base plan of 100 grand. But then remember, most states will allow the policy to double in value for cash for long-term care. So they're getting a second period of 25 months at another $4,000 per month. So up to $200,000 in cash for long-term care. Plus the death benefit will fully restore regardless of when someone passes. Before care is needed, during that care window, or even if somebody survives that care window. So often the policy can be worth up to 3 times in value of whatever the face amount of the insurance was. We even have some scenarios where it can be worth up to 4 times. So again, our strategy is to find the most long-term care protection for folks. It's just tied to a life insurance plan to make it stable. Now, one of the key factors of when you're working with us that can really help with an employer paid strategy to help with cost is the fact that we have carriers that will go down to just 5 insured. Okay. 5 insured that can include spouses and $150,000 or $200,000 in guaranteed issue in the life insurance. So again, whatever the life insurance is, it's usually worth double that in long-term care. But the fact that we have underwriting offers that will allow someone to get just a minimum plan of $10,000, and then at any future annual enrollment, because we conduct this annually, they can add another up to the guaranteed issue, up to another 140 or another $190,000 at a single medical question. So an employer paid benefit of that minimum value of $10,000 is very impactful because you now gave that person, that insured, a future safety net if anything ever happened to them and they were still working at that employer, where they can add coverage without medical questions, despite what bad news they may have gotten. Okay. Now, when we introduce these plans, obviously there's a buy up at the initial offering typically, right? So we're not telling people you can only get $10,000 and then wait till something bad happens. But some people might just get that $10,000, or that might be all the company is funding. But that future buy up, that future safety net, makes a small benefit go a long, long way. Okay, so keep that in mind as we're talking about these strategies. So there's a few ways to approach this employer paid strategy. Executive carve out only. and allowing a buyout. Executive carve out with voluntary for the remainder of the staff. Okay, so making it available to everyone, but it's not everyone getting a contribution. And then you can do employer paid base level of coverage for everyone with the staff buyout. And then one thing I do want to focus on are those grandfather group standalone long-term care plans, because we're getting questions and RFP requests for those basically daily at this point. So that is a very hot topic right now. So I'm going to walk you through a couple examples of some of these strategies. This first one was a somewhat small group. Okay, so it was just 10 executives, and there was an employer paid contribution of a benefit amount of $100,000 in life insurance. So the first 100,000 was funded by the employer, but then there was a buy-up allowed after that. So this is a very rich offering, an employer paid benefit. You don't have to do this much, but this was a very gracious employer. Because of, again, the future underwriting ability, because people had that first $100,000, they were able to, anyone who insured was able to add up to another $50,000 in this example because of the size of the group at any future enrollment. And some people did, take more coverage beyond that first $100,000 during the initial offering. So just off these 10 folks, there was $47,000 in annual premium generated, which gave our broker partner a little under $20,000 in first year revenue, assuming heaped commissions. Here's another example of an executive carve out where the remainder of the staff was allowed to participate on a voluntary basis. And this is a 1,000-person company. They had a lot of executives. They had 100 executives. And they, again, very rich offering, did $100,000 benefit for those executives. So the employer paid premium generated $470,000 in premium, $188,000 just off that employer paid for a broker partner. And then the voluntary funded amounts were $250,000 in premium, $100,000 in revenue. So total, it was just shy of $300,000 in total revenue for our broker partner. Now, here is another example where we had 1,000 employees, but they just wanted to fund that minimum $10,000 benefit for everybody. Okay, they wanted to get everybody's foot in the door, so they had the ability to have that future buy up in the future. So again, the premium on that was $25,000. To give you an example, if you wanted to, think what it would be for a 100-person group, again, you would divide that by 10, so $2,500 a month. That $10,000 benefit, it's based on each individual's age, so the rates will vary depending on the age of the group. It's not a blended rate, but this generated a total of $300,000 on the employer paid amount in premium, $120,000 on the revenue, and then $252,000 in premium on the voluntary side, with $100,000 in revenue, totaling in $230,000 in revenue for a broker. Again, those revenue numbers all assume heaped commissions. Now, the most frequent requests we're getting for employer paid scenarios or RFPs are replacing standalone long-term care options. So what's very important to know here is comparing a standalone long-term care plan to a hybrid policy is like comparing apples to oranges. And the rates comparatively as well are going to be much lower as of now with the standalone options. So that won't be the case, I don't think, forever. I think they'll continue to raise rates and price people out of those policies as they have been. But what's important to go into these conversations knowing is that this is not a replacement of the existing plans. What this is going to show people how to do is how to have a path forward in offering protection for long-term care for the folks that are not able to be added to their current standalone long-term care policies. And eventually, if they continue, the carriers that have the standalone plans continue to price people out of it, or just starting to discontinue coverage, that would be when we would look at, replacing or being a solution for the people that have the existing policies now. So we're going into these situations saying we don't want to replace what people have. Okay, we want to, we know, and we encourage that they keep those existing plans because it's going to be best for them. So we're never coming in trying to replace something that wouldn't be the best for somebody. Obviously, we wouldn't do that. So this is a path forward. Again, hybrid policies are the only way for a group to offer long-term care protection without medical questions at this point. So don't let your group get hung up on the fact of we're trying to replace this. Let's see a direct side-by-side comparison. That is not the strategy. But we have a ton of groups that say we already are paying for a benefit for folks once they hit a certain tenure. We can't add people now. What do we do? So if you look at offering the same exact amount of long-term care monthly protection, it may not be cost effective. So maybe you're having to reduce the amount of benefit that you offer because of that underwriting offer, right? Instead of you offering a $30,000 life insurance plan to give the exact amount of long-term care protection on a monthly basis that they have with their standalone policy, you're doing that minimum $10,000 benefit because the underwriting, the GI buy-up, that underwriting offer makes it more valuable. Here's another case study of a 240 person group that we did, where a $25,000 benefit was paid for the executives, generated $61,000 in revenue for our broker partner. And then lastly, a 48 person group where they did employer paid of $50,000. So even a small employer, 48 people, generated $63,000 to our broker partner right there. So even very small groups can go a long, long way when especially when there's an employer paid component to that. People are more invested in it. When you ask for an RFP, if you've asked for one before, basically we just add an extra slide that looks like this. We're typically showing benefit amounts for employer paid, however many number of folks you want to see. If it's the entire census, then we would show that 10, 50, 100,000. And obviously, if you wanted to see a carve out, we would just need to know the dates of birth of those folks to be able to generate the exact rate. Again, it's not a blended rate. It's actually on a employee by employee basis as well. Once a group says go, again, the enrollment and education for this type of plan is extremely important. It's not a known commodity. We have an 8-week timeline from when a group says go, from the time that enrollment begins, and we do 4 weeks of pre-enrollment education. It's not redundant emails or text messages saying the same thing over and over again. Think of it like a learning module. And if you don't do that, people are like deer in headlights. Okay. And we also focus on this plan off cycle from the core on a platform, Solarix, where the plan works well, the buy-ups can work, things of that nature. And we have an annual enrollment only. So it's not something extra that people have to manage on a month-by-month basis, especially with it being on a second platform. These are just examples of our learning module, pre-enrollment education. Again, short animated videos building up people's base knowledge. So once they get to enrollment, they have a basic understanding of what it looks like. And we even create tools where people can run through not just rate scenarios, but claim scenarios, see their return on investment. So this is very impactful again, and helps people understand the policy. So again, we're always helping people, our broker partners, not just enroll groups, right? We look at ourselves as a marketing partner, helping you find opportunities, doing the RFPs, helping you close the deals. Everyone knows it's a benefit that they need to think about, just not everybody knows where to start. That's why we're here. And that's how we get the participation that we get, which is again 5 times the industry average. So I know we're up here on time. I'm happy to answer as many questions as you have. Let's see if there's anything in the chat. You can unmute yourself as well. Any questions? All right, I don't see anything in the chat, but thank you again for your attendance. Thank you for those that are working with us currently, and those of you that are not, we hope to work with you soon. And I hope you took something from this today. Feel free to reach out to me about any opportunity that you might have, and I'll be sure to follow up with some of you as well. So, Chelsea, anything on your end?
Nope, we are all good. Thanks, Matt.
All right. Thank you, everybody. Have a great rest of your day.